Good morning, everyone. My name is Saras, and I'm part of the Secretariat team of Climate Governance Malaysia. It's a pleasure to welcome you to the Director's Masterclass and to open today's Fireside session on the topic of navigating climate risk, investors' priorities. This Masterclass is a collaborative initiative designed to sharpen your expertise in climate change, offering the most current insights and market developments in sustainability. We are proud to collaborate with Bursa Malaysia, the Asia School of Business, the Security Commissions, and ICDM, who have been played a vital role in promoting this session. Today's session is the result of a joint effort between Climate Governance Malaysia and Bursa Malaysia as part of PLC Transformation Program. We believe the knowledge shared today will be invaluable in guiding your business towards sustainable practices that harness nature's wealth for long-term success. Before we start, I would like to cover a few housekeeping points to protect confidentiality. Please note that there will be no recordings during the Q&A session. Additionally, please ensure your phones are on silent mode to prevent disruptions. Thank you for being here. We look forward to stimulating and informative discussion, and we explore the vital topic of navigating climate risk, investor priorities. Without further delay, I would like to invite Aina Zahari, Director of Corporate Strategy at Bursa Malaysia, to deliver her welcoming speech.
Thank you. Good morning, Climate Governance Malaysia and all board members. This session marks the third year, actually, of our ongoing collaboration with Climate Governance Malaysia as part of our sustainability-related topics under the PLC Transformation Program. If you don't know, I think I always say this for those who do come, I think, board members, probably most of your companies, if not all, are members of the PLC Transformation Program, where it's really intended to help drive best practices and action in the PLCs among your companies, because we want higher corporate performance in the long run. So if you haven't recently asked your senior management how they have been doing things differently, please do maybe just remind them, just a gentle nudge, because we didn't make it prescriptive, but these part of these sharing sessions with board members is to help to drive some of that action. So, in fact, actually just 2 months ago, we hosted corporate leaders, directors like yourself in one of the masterclass earlier on biodiversity matters, leveraging nature's wealth for business sustainability. I remember some of you attending that session, and thank you for coming again for some of that. So this session will build on some of that momentum to help drive some of the specific strategies here now on climate risk management, in particular as you engage stakeholders and particularly investors. Right now, we're witnessing positive impact of Malaysia's robust fundamentals on the economy and the capital market. At Bursa, we're very happy that we've had a very strong year. The first half of the year, coupled with optimistic outlook, there's the market capitalization reached the record threshold of 2 trillion in May 2024. But to sustain this investor interest by both foreign investors and domestic investors, we will need that solid corporate earnings, which is what investors see and ask about when they compare Malaysia's, investing in Malaysian companies as opposed to regional companies abroad. That still, despite, I'm sure you'll get into more of that rhetoric, but despite which they will look for, best practices and how you're managing, the bottom line does matter. And then the topic today is integral, not just on climate, but it's also on your sustainable performance. So that's why we're heartened to see a bigger turnout today than actually other years. So we've had this set up for today to hear and talk about navigating climate risk and investor priorities. As you know, it's not an environmental issue, but it's a business one where all companies, all governments need to do together to limit temperature rise, and it will have impact on your businesses and society. As corporate leaders, board members, it is essential to integrate climate risk assessments into your strategic planning processes of the organizations. This means understanding how climate change affects supply chains, production methods, and market dynamics. It requires solid engagement with stakeholders, not just investors, customers, employees, local communities, to foster transparency and collaboration in addressing some of these challenges. As Malaysia and businesses transition to a low-carbon economy, there's a lot of potential in developing sustainable products and in getting more of that supply chain from the region as well as global by having solid sustainable practices. So from market regulator perspective, important to recognize the growing expectations from investors. There's a study by the United Nations Environment Programme Finance Initiative that says 85% of financial institutions have integrated climate risk into their governance frameworks, reflecting a significant increase in regulatory compliance and oversight on the matter. Investors are seeking transparency. I'm sure you're getting a lot of questions on what is being done on sustainability in the organization, in your communities, and in your products, not just by suppliers, but also investors. So with the session today, we hope to highlight best practices. Feel free to ask a lot of questions to our expert speaker from his vast career that we will go into in a little bit. And finally, please hopefully it'll percolate some of the ideas within your organization of how you can encourage the organization to do more and to bring up the rest of your supply chain for Malaysia's betterment. I look forward to discussions and insights that will emerge from today's session. Thank you.
Thank you, Aina, for your welcoming speech. We now move on to the much anticipated fire chat session with Amar Gill, Secretary General of the ACGA. This session will be moderated by Datin Sri Sunita, Rajakumar, Chairperson of Climate Governance Malaysia. Let's warmly welcome Amar Gill and Datin Sri Sunita to the stage.
Great. Thank you so much, everyone, for coming out this morning. It's so good to see so many friendly faces in the room. I really appreciate the support that you've been giving Climate Governance Malaysia. So Amar and I go back a really long way. From when he was working in KL, he left for Hong Kong in 2001, more than 2 decades ago, and of course most famously at BlackRock, and now running the ACGA as well. So really doing super important work on corporate governance, and as we recognize, climate governance is a subset of that as well. Critically important to everyone in the boardroom. I think to set some context, I want to remind us that we're living in a time of macro polycrisis, where the cost of action is increasing the longer we kick the ball down the road. The cost of inaction is also increasing, and there's almost a zero regret option. This is what we do know. Scientists are unanimously have consensus that the cost of inaction is going to be unimaginable. And against all of this, despite universal recognition, despite even recognition that all humans have a right to a safe, healthy, sustainable environment, we are also seeing what is known as tragedy of the commons, where the public good is not being protected, the marketplace is failing, it's a classic market failure, and there's increasing recognition that businesses have a social license to operate. So what is the responsibility of businesses? Not only to recognize, identify, manage, mitigate risks, but also seize opportunities as they are arising. And this is what I want to try and unpack with Amar today. The multiple tensions that we are seeing between the need for climate action and the sharpening accountability that we are seeing versus the inertia and the dilution of ambition that we're also seeing, especially in recent months. The tension between the partner-guardian role, where you want to be a partner to the business, and yet you need to be a guardian or steward over the assets of the business as well. the tension between institutional investors and their role in supporting the business and management, and yet needing to signal the direction of travel that really all of society has indicated they want to see. The balance finally between existing levels of capacity, what we know, what we can do, and in this uncharted territory, and the urgent need for increased assurance and verification in a transition journey that's still evolving. So I'm going to start off by just kicking off by inviting Amar to give some opening remarks. I'll have some questions for him, and then I'll open it to the floor so that you can ask him questions as well. So, Amar, if you could please share your thoughts behind the need for climate governance. Thank you.
Okay, thank you. Is this working? Oh, thank you. Thank you, Sunita, and Climate Governance Malaysia for inviting me to come over and share some thoughts with the directors of companies over here, and for Bursa Malaysia to be hosting this event. Maybe just to set the backdrop a little bit about my background. I'm obviously Malaysian, born in Batu Gajah, by the way. For those who are of my age at that time, Lat the cartoonist, all his big town was Batu Gajah, and which is where I was born, near Ipoh, many years ago. I joined, when I came back from university, I was with Southern Bank, and I joined Southern Bank Securities. Then I moved to Rashid Hussain around the mid-90s, and that's where Sunita and I were colleagues for a while. I look my age, she does not look her age. So I was with Rashid Hussain until sort of 95, end of 95. And then I joined CLSA, and I was with CLSA for 22 and a half years. Initially head of research in Malaysia during the Asian financial crisis from 95 to 2001. I was senior analyst and covering companies like Tenaga. I was the analyst for Tenaga when Tan Sri Azman was the investor relations officer at Tenaga Malaysia. So I've known Tan Sri Azman for about 20, 30 years, and I have tremendous respect for him and what he's done at Khazanah as well. I then moved to Hong Kong in 2001, and I was head of research for Hong Kong, and I became Asia regional head of research. But throughout that period, I was also writing CG Watch reports for CLSA. CLSA started CG Watch in 2001, and it was a response to the Asian financial crisis and how companies fared and what companies were doing and how to determine which were good companies and which were companies that were ripping off shareholders. Because at that point, you're a young analyst, you do your DCF models, you do your NPV, and you try and figure out what is the right discount rate, risk premium, etc. But then when it comes to a crunch and shareholders are under stress, and controlling shareholders have got private business interests, everything is geared up to the hilt. Usually, at that time, US dollar bonds and US dollar borrowings, because US debt was supposed to be lower interest compared to ringgit debt, but of course that's without covering the FX risk. So all the conglomerates and big companies in Asia, including Malaysia and Indonesia and Korea, very highly geared. And then of course with the collapse of the baht and other currencies here also falling, these companies became insolvent. And so the controlling shareholders had to determine. They have their private interests, and they've got their listed companies. And listed companies, they own 30, 40%. Private interests, they own with their family, probably 100%. So they were bailing out the private interests. They were injecting businesses into the listcos to get capital out of the listcos, and so on. And so as an analyst, what was the real lesson of the Asian financial crisis is you can do your DCF, but your DCF and NPV is assuming things don't change. But in businesses in Asia, that is probably the most unrealistic expectation, right? And when you have RPTs and when you have private interests that controlling shareholders have, the question then is, are the controlling shareholders interested in treating minority shareholders equitably? Right? We're investing in equities, but are the minority shareholders being treated equitably? that was, for me, the big lesson from the Asian financial crisis and how I started to be interested in corporate governance and started doing the reports on the CG Watch reports starting from 2001. So I was with CLSA until, all in all, 2018. Then I moved to BlackRock. In 2018, I was with BlackRock for 5 years until last September. BlackRock, not that well known in Malaysia because it doesn't have an office in Malaysia, but it is the largest asset manager globally. 10.6 trillion US dollars AUM as at June a couple of months ago. Of that 10.6 trillion US dollars, 50% roughly is in public market equities. And of the 50% that's in public market equities, 90% is in passive strategies, i.e. the ETFs, right? And we can talk about passive and active, and I think it's worth a discussion. But essentially, passive investors are long-term investors. As long as a company is in the index, and BlackRock generally follows the MSCI, so if the Naga or Telecom or Bursa is, as a listed company is in MSCI, then the funds of BlackRock, these ETFs, will be investors of these companies indefinitely. And so the big advantage is in the stewardship team that you can go and you meet the controlling shareholders, you meet the management, and you can say at the outset, our investment horizon, BlackRock's investment horizon, is the same as the controlling shareholder. It's indefinite. We are BlackRock's a long-term investor. And BlackRock had and still has the largest stewardship team. So I'm not sure that stewardship as a concept is fully understood, but essentially for asset management companies and asset owners, the stewardship function is where the asset manager is exercising the fiduciary responsibility for the investors to be working for long-term shareholder value. And what that means is voting at AGMs and EGMs and having engagements with senior management and hopefully with directors, hopefully with independent directors, to understand how the board functions. And then using those engagements to vote, re-elect directors and so on. So the other aspect of BlackRock is because it's a long-term investor, sustainability and long-term vision and long-term shareholder value is incredibly important for the business model of BlackRock. And the chairman, CEO, Larry Fink, from about middle of 2010, about 2015 onwards, he started writing these annual letters. And the annual letters were emphasizing ESG, sustainability practices, long-term shareholder value, and why that is crucial for value creation in the markets. I'd say BlackRock was probably one of the strongest advocates globally on ESG and taking climate risks seriously. One of the things that BlackRock was doing from the time I was there, end of 2018 to 2023, is advocating for TCFD, which I'm sure most of you have heard of, Task Force Climate-Related Financial Disclosures. And there are 4 pillars of TCFD. There's the governance, there's strategy, there's risk, and the final pillar is reporting metrics and targets. And so what BlackRock introduced from around 2019 or 2020 was that if companies did not, if companies in the relevant high carbon intensive sectors were not reporting by TCFD, if they were not coming out with medium and long-term targets on Scope 1 and Scope 2 emissions, then BlackRock would vote against the re-election of directors. And it would choose the most relevant executive director as well as one INET as well, because it's a responsibility for the non-executives and the independent directors as well. And often BlackRock would then come out with a public statement that it would put on the website, and sometimes it gets picked up by the media when it was voting against directors, when the directors were not taking sustainability issues, climate issues seriously. So I was at BlackRock, and we can talk a little bit more on the policies and what, how ESG has evolved within big asset manager like BlackRock, until last September, when I moved over to ACGA. Now, ACGA, Asian Corporate Governance Association, was established in 1999, about 25 years ago. And again, it was a reaction to the Asian financial crisis. And it was established by my predecessor, who's been Secretary General for 24 and a half years, Jamie Allen. And it has a council of 8 senior people, most of them from investment management backgrounds. And right now, ACGA has 102 members, of which 80% are institutions, institutional investors, and it includes BlackRock and Vanguard and Fidelity and Schroders, includes the asset owners. Temasek became a member of ACGA a few months ago. Norges Bank, the biggest sovereign fund in the world, from Norway, has been a member for a long time. In this region, the pension fund for Korea, NPS, is a member. And we have super funds, superannuation funds from Australia. We have CalPERS and CalSTRS from the US, and we have some of the Canadian asset owners as well as members. So 80% of our members are institutions, and 20% of our members are corporates, as well as organizations like Eclipse is a member, the business school that Bank Negara set up. ADB is a member, and so on. But we also have, Ismet from MSDW, Minority Shareholder Watchdog Group, has been coming to our conferences. Because Aina comes to our conferences, etc. So that's the background. That's where I'm coming from. I think the climate challenges is obviously a very complex issue for boards to be dealing with. And there's been a backlash on ESG, and that's what I was mentioning a little bit, where BlackRock is moving away from, and it's become very political, particularly in the U.S., because you have the oil-producing states, the red belt, as they say, on the southern side, Texas, Oklahoma, and a few of the others in the U.S. Almost all of them controlled by the Republicans. And essentially, the view that they had was any asset manager pushing forward the ESG agenda were, by definition, against oil. And these are oil-producing states. And so some of these states basically said to BlackRock and other asset managers is, if you're pushing the ESG agenda, then our pension funds are not going to go to you, because our economy is based on oil and gas. And so there was this reaction to the sort of woke capitalism, and the reaction that came on the Republican side was that the liberals in New York and California are pushing on the ESG and sustainability issues, and it was not seen as in the interest of shareholders, because shareholders should be only interested in shareholder value, in share prices going up. Right? Now, I think the view that a lot of asset managers have, and certainly for the long-term investors like EPF and Khazanah and so on, is that you have to have a balance. You can't be just looking at short-term profits, because if you don't look after sustainability, climate issues, and social issues, then your business doesn't have a long-term value. Right? It's simply like capital expenditure. You have to invest for growth in 5 to 10 years' time. You cut down your capex now, it might help your profits in the next 1 or 2 years, but that's not a sensible policy. So this shareholder priority versus stakeholders, it's really a question. It's really a balance. Where do you put the balance? I think that around the turn of the century, the turn of the last decade, 2018 to 2020, 2021, there was a big push by climate activists, most of whom didn't have significant holdings in companies, right? They would buy 100 shares or whatever minimum amount to be able to put a shareholder proposal in Australia and other markets, or they would have a campaign and get the asset managers to put shareholder proposals to companies on what they were doing for climate change and what they were doing to reduce emissions by 50% by 2030. Now, this global goal of cutting emissions by 50%, 45% that Climate Action 100, et cetera, had, it's easier to put that in place in economies that are not growing. It's easier to put that in place in countries that are not increasing their manufacturing activities. But in countries like India and China and Indonesia, where economies are still growing, companies are looking to expand their activities, and you talk to the CFO and the strategic officer, et cetera, they'll be planning for at least 10 or 15% growth per annum, which means in 10 years' time, they expect the business to be at least double, in fact, more than double if you're growing at 10% per year. So if the business is growing and doubling in 10 years, but you're expecting your emissions to be cut by almost 50% within 10 years, it doesn't work in emerging economies, right? So I think a lot of the environmental activists were pushing an agenda that was just not practical and realistic in emerging markets. And that led to some element of this backlash. And then, of course, you had the Ukraine war invasion, and that led to oil and gas prices going up and coal price going up. So these ESG funds that were underweight coal and underweight oil and gas, since 2022, they've underperformed. As a result of which, since mid of 2022 to now, you've had outflows from ESG funds, right? So the pendulum had swung quite a bit towards climate, in particular, being the most important issue that boards have to be focusing on. It is now swung back. For some asset managers, you can't even talk about ESG, and BlackRock has stopped using the term ESG since last year, 2023. But what BlackRock is talking about is materially relevant sustainability factors. And so a business model essentially has to be looking at delivering shareholder value subject to constraints, subject to the social license to operate, that you have to be a responsible corporate citizen, and you also have to be a responsible citizen when it comes to your impact on the environment and emissions, etc. If a country has NDC targets, you need to be following the NDC targets of your country. If you're exporting to Europe or the US, then you also have to be following the laws and regulations to be able to penetrate to those markets. That makes it materially relevant. And if boards are not taking this into account and leaving it to management, then boards will be, directors will be held accountable. So one example of that, moving slightly away from climate per se to deforestation, early this year, Norges Bank, which is one of our members of ACGA, and as I mentioned, the biggest sovereign fund globally, they have, because they're so big, $1.4 trillion US, and almost all of it in equities. So Norges has about 1% in every major company in the whole world, right? Here in Malaysia, one to more than 1%. In, I think, Bursa, Malaysia, they have like 3 or 4%. But they had about 1% in some of the Jardine Group companies, Jardine Matheson, Astra, and United Tractors. And as, Jardine is listed in Singapore, Astra and United Tractors listed in Jakarta. Early this year, Norges Bank announced they were divesting. They announced that they could no longer be an investor in the Jardine Group. And essentially, that was because there was an issue of deforestation that one of the Astra subsidiaries was expanding its mine in northern Sumatra in an area that was a habitat for orangutans. And essentially, even though the Astra subsidiary, had their own sustainability committee, they had 4 experts on ecosystems of jungles and orangutan survival, etc. They had their own experts, but Norges Bank's policy was, when you are expanding and cutting down the forest, you need an organization called IUCN to be consultants that you are doing it responsibly. And Astra was working with IUCN for about a year or so, until the IUCN announced that they could no longer work with Astra because the data and information that they were looking for could not be provided. And Datin Group say that it's partly because the government was restricting that information could not be disclosed according to local regulations. But also part of it was that IUCN wanted a 20-year study on the habitat of orangutans. And Datin Group thought that was no point in that. So they weren't doing some of the things that IUCN was looking for. So because IUCN stopped engaging with Astra, Norges Group basically came to the view that they were not confident that Astra was being a responsible corporate citizen when it came to the forest in Sumatra. And they made a big announcement, and anybody following the Datin Group and all the other investors would also be able to see Norges Bank is divested. All the other institutional investors would have to consider it very seriously whether they can continue to be investors. Now that is deforestation per se, but that sort of risk where a major institution divests, makes an announcement, it's a red flag for all the other investors. And in those sort of situations, it's incumbent that the boards be ensuring that the management are on top of the issues, that you have a credible international organization that is assessing the risks of your operations. And, I'm coming to the end of what I was preparing, what are my prepared remarks, if you like, that going forward, you will have increased sustainability reporting by this ISSB, the International Standards of the International Sustainability Standards Board, which is part of IFRS. So this is now becoming the international reporting standard for sustainability. And the big issue will be data integrity, right? So you have the managers getting the data on emissions and so on, but whether that data covers the core business areas or the relevant business areas. So if you're a Hong Kong company, but you're only producing data for your operations in Hong Kong, but your mainland China operations is 90% of your business volume, then whether you're covering all the core and relevant areas, right? That's the S1 in the ISSB standards. So this data integrity, collecting all the relevant data and collecting it correctly, and then getting assessors, independent third parties to assess that your data is correct and relevant. It is just like financial statements. If you don't have credible auditors to audit and assess your financial statements, then your financial statements don't have the credibility with international investors. And similarly, with sustainability reporting, if you don't have credible assessors on your emissions and how much emissions have reduced, intensity, and so on, if you don't have credible assessors, then again, it will be discounted, the information that's provided on climate reporting. So it's, I think, crucial for boards to be thinking about the data that's coming from management and whether that data is assessed and verified by an independent third party. Because if it isn't verified and isn't validated by an independent third party, the companies are at a serious risk that major shareholders, A, might vote against the directors of the company, and or B, divest and make a statement about divestment, which creates obviously all sorts of reputation risks. So that's a little bit longer than I expected, but maybe we can sort of open up to some discussion.
Brilliant. Thank you so much, Amar. That's given us a really good overview, and especially wearing both hats, where you were in BlackRock and now at ACGA, pushing the envelope forward when it comes to corporate governance. So I want to unpack the last points that you made on the increased need for verification assurance, that it comes from a credible international organization. So again, this leads to a tension between the business wanting to grow, especially in emerging markets or industries that are still experiencing rapid growth, versus the sharpened accountability disclosure that we're seeing from not just the wave of reporting requirements, but also the increased awareness. So it's not just emissions. You gave the example of even deforestation, destruction of biodiversity. So can you share with us your thoughts on how businesses can balance both of this when we're trying to deal with this tension between growth and yet what might be perceived as an expense rather than an investment in the future sustainability of the business?
Yeah, that's the crucial challenge for boards and management for companies that are in growth markets like Malaysia. I think the important factor and the important data point is your intensity, emissions intensity. If you're growing, at 10 or 15% per year, but you're able to reduce your emissions by 10 or 15% per unit of volume, then your emissions at least are flat, even though you're growing your business significantly. So I think it's very important to be looking at the emissions intensity, total emissions, whether it's just carbon or GHG and so on, divided by the output. It's also important to look at whether your denominator, what you're dividing by, whether you look at it in volume terms or value terms, the ringgit or value of your turnover, or whether you're looking at the volume of your output. And the key thing, both are important. Obviously volume is very important because you want to see how efficient management is to reduce emissions divided by the total output by volume. But value is also important because in emerging markets, if you take pharmaceuticals, for instance, and this was a point made by one of the senior regulators in India in our conference last year. You look at pharmaceuticals and all of the other products, the selling price, ASP, much lower, is like a quarter of the developed world. And the margins in currency terms, whether it's US dollars, etc., also much lower than in the developed world. So when your margins in absolute dollar terms and your selling price is so much lower, your ability to invest resources to be able to be cleaner, to be able to be more efficient in terms of emissions, etc., is also reduced, right? Because your margins are lower. And if if you're under pressure from some of these environmental activists that you need to cut your emissions, and so you need to have new equipment that's more efficient, etc., but it wipes out your margin, then what the business operations becomes that issue. So I think actually the emissions intensity by volume, and then for that sector by value, and comparing with other companies globally or regionally, emissions by value terms is also relevant. And that is probably the most important, these two metrics of intensity, probably the most important to at least show your shareholders that while you're growing a business, you are making a serious effort to be more efficient and to be more responsible in terms of emissions.
Yeah. So I think the challenge in the boardroom is that we've moved away from traditional concepts of materiality, a percentage of indicators in the audited financial statements, to double materiality, dynamic materiality. We're trying to identify and manage these multiple tsunamis coming in our direction. So not just increase reporting and disclosure, which is going to increase our accountability, climate litigation, most recently Supreme Court in India, which has a lot of parallels for us, a similar constitution, which recognizes that everybody has a right to a safe, healthy, sustainable environment. And we're going to have a recap of global litigation in the upcoming summit. Client Earth is going to walk us through the global climate litigation scenarios. And how is the board supposed to address, and of course, sorry, carbon pricing as well? So the moment we start pricing carbon, many businesses are going to go out of business. At the mandatory emissions trading schemes in UK and EU, prices reached $100, and there are not many businesses that will be able to survive that. And in Malaysia, for NDCs, for example, we've seen that emissions intensity actually leads to a doubling of absolute emissions. So it's very easy to get caught out, although we're complying with, for example, NDCs, but to be caught out by still not doing enough, especially knowing that we're reaching a tipping point. We're already at 1.5 degrees of warming. We've had a few days of 2 degrees of warming. The 2 ice sheets, if they melt, is going to lead to 10 meters of sea level rise. And you know, when we have more frequent, more intense extreme weather events, we're already seeing regional heat waves that were happening once in 200 years, happening on an almost annual basis, droughts, water shortage in a country which has no food security. How can directors anticipate which of these tsunamis are going to hit the business sooner rather than later and manage these risks from the corporate governance perspective?
Yeah, obviously a lot of issues there and a lot of challenges that boards have to face. I think the biggest single thing to be aware of as a NED on a board is, are you getting enough information from outside the management? Right? The boards are supposed to oversee management. It's a key responsibility, key expectation of international investors. And I'm sure even, you know, our Khazanah and EPF and PNB, they expect the boards to be overseeing the management. But if all the information that you're getting is from the management, is that the effective oversight of management? Right? It's, you know, it's a little bit like your child comes home with a report card, but the child rewrites the report card and gives it to you, right? So I think it's actually crucial that boards be getting the relevant, not the data. The data obviously has to come from management, what is happening within the company. But the issues that are being faced in that sector and how technologies are moving, what is the most economically viable transition pathway in your sector? Whether it's automobiles, whether it's shipping or airlines, or energy companies. And for that, you need to be discussing with experts in the sector that the independent directors reach out to, because they are the credible experts in that sector. So I think it's actually very, very, you know, education on sustainability challenges, climate challenges is a key part of the role for the board members. And it's important also, I think, for the board members to be getting the feedback from investors on market concerns. You know, so the investors in a bank, the investors in a utility would be investing in these companies, you know, with the regional investors, global investors. They'll be investing in these companies in the other markets as well. They will have an idea on what is required to have a business model that is credible in transitioning. And so boards, and particularly independent directors, should also be engaging with the investors and the shareholders to get an idea what the market concerns are and whether the company is doing enough relative to what other companies are doing in this region and in the developed world. That interaction between independent directors and asset managers among the stakeholders is also very important. And I think it's beginning to develop. You're getting stewardship teams, you're getting senior independent directors who are beginning to engage with their shareholders. But I think you need much more of that so that the concerns that the market has goes straight to the board rather than investors always just talking to management and management then filtering it to the board. So I think that direct communication of board members with industry experts and with investors and shareholders is quite crucial.
Thank you so much, Amar. I think that's exactly the gap that CGM is trying to fill. And also, in addition, we actively do a lot of advocacy work with policymakers, regulators, so we keep them informed as to what private sector would like to see as well. I'm just going to ask you one last question before we open to the floor for questions. But I want to pivot for nature positive now. So a lot of the conversation has been about emissions. You gave us an example of deforestation and biodiversity, specifically orangutans. So there's increasing recognition that all legal tender is underpinned by nature, and that nature catalyzes almost every layer of the climate finance stack. As a matter of fact, some investors think that by next year, if a business doesn't start evolving a nature positive positioning and strategy, they will lose credibility very quickly. What are your thoughts on this, extending the conversation from not just emissions, NDCs, IPCC, to nature, TNFD, and so on and so forth?
So biodiversity obviously is a big issue, and biodiversity plus water, I think those are the two main aspects of TNFD. And these, these are issues that are important in a lot of sectors, and particularly businesses in this region. So TCFD got formed about 10 years ago, and when you look at the Sustainability Standards Board, what IFRS is rolling out globally, and exchanges, regulators in all the markets will be rolling out this ISSB in the next 2 or 3 years. It's incorporated the TCFD requirements in the sustainability reporting that's required for companies. And actually ISSB is a very, very positive development, because I'm sure everybody here has also heard of this alphabet soup of different reporting standards, etc., right? GRI, SASB, integrated reporting, SASB, and so on and so on. So which reporting standards should our company be reporting by? Now, the fact that the International Financial Reporting Standards, IFRS, pushing out ISSB will be the sustainable, as they say, global baseline on sustainability reporting across markets, across all the different markets, and it makes it easier, or it makes it doable for a regional portfolio manager to be comparing the sustainability reporting in one market with another market. Now, ISSB is incorporating practically everything, in fact, everything from TCFD, plus they're incorporating some elements of SASB and so on, right? TCFD is fully incorporated. Now, TNFD was only established, I think, about 2 years ago. And TNFD now is basically where TCFD was about 7 or 8 years ago. So you can take it that within 5 years, the reporting standards recommended by TNFD will almost certainly become part of the ISSB/IFRS reporting standards. So if your company is involved in anything, that palm oil, for instance, but also where water is a critical element in your operations, then you should be aware of the TNFD and what is the data reporting that's required, because within 2 or 3 years, your company will have to report by TCFD and ISSB, and within 5 or 6 years, the TNFD reporting will also be required, and so you need to make sure that the collection of data is in place.
Thank you so much, Amar. I think we've had a great session. We're running a little over time right now, but thank you so much for your attention, and let's give a big round of applause to Amar.